back in the news again, but in a very different way to this time last year. Nationally, property values recorded the fourth consecutive month of growth in October, taking growth values to maybe around 3% higher over the quarter. So rather than worrying about property Armageddon, now the commentators are asking how strong are the property markets going to be, with recent forecasts suggesting dwelling values could even rise 15% in Melbourne and Sydney next year. Now, after struggling for 2 years, Australia's housing markets are on the up, and interest rate cuts, tax cuts, reduced uncertainty around the housing markets, positive media, and I guess looser banking restrictions have definitely generated a significant improvement. But what's really ahead for our property markets in 2020? To put some reality to the forecasts that are out there, let's have a chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of myhousingmarket.com.au. Welcome, Andrew.
Thank you, Michael. Yes, good to see you again.
Now, it's that time of the year again, Andrew. Spring has sprung, the flowers are out, and little creatures have come out of hibernation. They come out every time this year. They're called a property forecaster. And they've been out in force lately with widely varying claims. There were some very strong claims, according to SQM Research's annual Housing Boom and Bust report, suggesting that we could have record dwelling rises in 2020, particularly in Sydney and Melbourne. On the other hand, the CBA Bank have come out with more modest forecasts over the last week, suggesting that prices may only increase by 7% in Sydney and 8% in Melbourne. So what's ahead in your mind? Are some of these wild claims really possible?
Well, Michael, I think the general populace would be a little dizzy given the change in forecasting over the last 12 months. We've gone from scary bust to crazy boom in the space of 12 months. And I guess it generates headlines and some interest. And we have to regard it as perhaps just a marketing ploy at the end of the day. Don't believe we're going to get anywhere near double figure growth in either Sydney or Melbourne next year. I'm a little similar to those other more conservative forecasts. In fact, a little more conservative. I think that we're looking around about 5 to 7% next year in the Melbourne and Sydney markets, and a little bit less in the other capital city markets. We can see that unfolding now, actually, when we look at the nature of our real-time market data, which is auction clearance rates. That's now certainly having looked like it's past its peak, and I think that we'll start to see an easing in prices growth, certainly not price declines. Prices will continue to grow at certainly a good rate for those that are selling their properties, and it still is a seller's market, clearly, in Melbourne and Sydney, but I don't think we're going to see the sort of price growth forecasts that are starting to do the rounds at the moment.
To make it clear, what you're saying is they've reached their peak in the acceleration of growth, but it's not reaching their peak in price. And the graphs that we're showing at the moment show that the Melbourne auction clearance rates have tapered off a little bit, and so has Sydney. But Andrew, that's pretty common in springtime as we get more listings, isn't it?
Absolutely, Michael. And we see that every year because as the market matures through spring, more listings come in. But look, at the end of the day, clearance rates are still quite heady in terms of it being clearly still a seller's market.
The predictions of double-digit growth or significantly more than double-digit growth have maybe been based on the fact that we've had quite strong growth over the last couple of months, but it's particularly in Melbourne and Sydney. And I agree with you, it's unlikely to continue because there are some headwinds ahead. And there's been a bit of economic news that would indicate that it's going to be a little bit tougher moving forward. Recently, it was shown again that unemployment's on the rise. For the first time in 3 years, the unemployment rate jumped back to 5.3% in October. The spike in unemployment was particularly in New South Wales and a modest rise in Victoria as well. And on top of that, the number of workers looking for more work has risen as well. And what that really means is it's pushed out even further the Reserve Bank's target of full employment, and what they're saying is 4.5% or lower. So I guess we are likely to have another interest rate drop, but they haven't worked now, so why should it work next year?
Yes, Michael, there was some surprising data to some degree released recently. As you suggested, the labour market data was particularly sobering from the Reserve Bank's point of view. They would have been hoping with 3 quick-fire interest rate cuts that would have generated the type of confidence and energy in the economy, start to see signs of a reduction in the unemployment rate. They were hoping to get a 4 in front of that unemployment rate with those interest rate cuts. I think now they'd be just happy to stop unemployment rising towards 6. But I do think the really concerning job statistic, Michael, was the fall of 19,000 jobs over October, which was certainly a surprise. It's the first fall in jobs growth that we've had for quite some time. It does look towards another rate cut, which I think we will get one more early next year. The other problem that we had, Mike, which was a little bit of a disappointment again to the Reserve Bank, perhaps not a little bit, but a significant disappointment, was the wage index data, which actually showed wages growth, annual wages growth falling. So we're not even seeing drive from those economic stimulus factors into increasing wages growth, which is critical to the whole structure of the policy settings of the Reserve Bank.
Well, the interest rate cuts haven't had the effect of people spending more. People are stashing their cash, they're paying down their debt. And on the one hand, that's good, but it also leads to what's sometimes called the paradox of thrift, which says if we all save more without any significant spike in spending from, say, businesses or government, then the economy actually contracts, people lose more jobs, and we end up saving less. It's an interesting situation we're getting ourselves into, Andrew.
Well, that's right, Michael, and the savings ratio is very low at the moment, and that's because people are having to spend to some degree to survive. But at the end of the day, we've also seen data out from the Commonwealth Bank that shows that people are paying off their mortgages now. In fact, arrears have fallen, which sort of puts again another spanner in the works of those that were predicting a debt bomb. Whatever happened to that? Look, that's a positive thing on one end, but the other end, it's you said we need to have the whole purpose of interest rate cuts and tax cuts is to stimulate spending, consumption in the economy. That's what's missing at the moment, and it just hasn't happened. And
we're sounding a bit negative, but I think what I'm trying to say, and I think you also, is to suggest that there are some headwinds and certain reasons why it's really unrealistic to have 15%, 18% capital growth next year. Another issue, Andrew, is business confidence is poor. Investment in new products, equipment, factories, employment's being put on hold. Some are worried about the local recession, and others are still worried about things like overseas with Brexit, with geopolitical problems in Hong Kong, with US-China trade wars. So business isn't spending either.
No, well, it's just a mindset, Michael, and we're not alone here. This is a global phenomenon. The weak impact of monetary policy has policymakers scratching their head. Most advanced economies have high budget deficits. That's the one positive for Australia, that we're still in the black. Look, I'm always positive about the Australian economy because of our resources sector particularly. And we have other strong drivers of exports, you know, in terms of education and agriculture and tourism.
Well, you said the government is able to spend. Currently, though, they seem a bit reluctant. Josh Frydenberg is gambling, waiting to deliver a surplus in his first budget, hoping the economy is going to just rebound a bit in 2020 beforehand. But there is also some good news. So despite all those difficulties, let's not forget house prices are rising. And I think we both agree they will continue to do so in 2020. And the wealth effect of that should help homeowners feel a little bit better, feel a bit more confident as their properties become more valuable. That in the past has allowed them to feel confident spending.
Yes, Michael, look, we started the discussion regarding almost outrageous forecasts of near 20% growth in house prices in Melbourne and Sydney in 2020. I think the market really clearly is revealing itself now of where we're headed with some certainty. The Melbourne and Sydney market are still tracking around about 5% below where they were at their previous peaks 2 years ago. They're in catch-up mode. They will catch up within the next 6 months on current growth trends. The question will be then, what will drive the market? We will have probably the end of the interest rate cutting cycle then. We have rising unemployment at the moment, although not a big negative to the market, does play its way into the mindset of buyers and sellers. But when we look at the other capital city markets, Michael, we can see there's a clear difference between prices growth in Melbourne and Sydney, which is currently strong, and that in Perth, Adelaide and Brisbane, which is currently modest. And I think that the question is, why haven't those markets boomed in terms of prices growth over the last 3 to 6 months as the Melbourne and Sydney market has? Well, the point is that in the case of Adelaide and Brisbane, their markets are still around about their previous peak price points. So they don't have that sort of catch-up energy driving them that Melbourne and Sydney do. And that shows us that interest rate cuts aren't having the same effect on prices growth as we've seen previously. And I think that points to the future, that once the Melbourne and Sydney market get back to around about where their previous peak points were 2 years ago, there'll be a much steadier price growth environment. I still think it'll be positive. I think we're looking at, over the longer term, all things remaining as they are now, around the longer term at around about maybe 3 or 4% per annum, depending on local circumstances. Of course, there's a couple of bits and pieces that might stimulate our markets early next year, Michael, and that's the first home buyer deposit scheme, which will bring, I believe, thousands of first home buyers into the market in a short period of time, which will put upward pressure on prices. And of course, we're still awaiting the return of investors into the marketplace, which I think is a key reason why we're not seeing underlying increases in prices growth at the levels we've seen before, which I still believe is a fact of still difficulty in investors obtaining finance rather than investors sitting on their hands.
So all the fear of a property crash of 20%, 40% of Armageddon, of a debt bomb exploding, a ticking time bomb sitting underneath us, hopefully that'll disappear from the headlines, and we could look forward to a steadier growth. And that's much more comfortable to live with, Andrew. If we got 15, 18% growth, I can see APRA stepping in very quickly to stop another property boom.
Well, that would only be if we had the investor heat driving the market, and that's way down at the moment, Michael, and that's why we won't see those sort of results, because it's going to be a long journey for us to get back, particularly in the Sydney market and to a lesser degree the Melbourne market, to the type of investor participation we had 2 or 3 years ago, which really did fuel strong prices growth. That's another reason why we're certainly highly unlikely to see those double-figure plus prices growth that have been predicted.
It's the beginning of a new cycle, and new cycles are usually driven by owner-occupiers and often first-home buyers, as we're finding now. And investors, a new generation, a new wave of investors, usually only get in closer to the end of the cycle when they're driven by fear and greed, fear of missing out and greed of missing out on what the other people got in the first part of the cycle. So there's quite some good times ahead. Thank you very much, Andrew. Look forward to catching up with you next week for our regular chats.
Yeah, thanks, Michael. Thanks a lot.